round. We'll focus on inflation and this morning's PPI data that we received. Ryan Payne is with us, President, Payne Capital Management, and Erin Gibbs, who is now also has a title of CIO, Main Street Asset Management. Thank you both for being with us. Erin, I'll start with you. So we got this PPI number in, and the year over year actually shows this big move here that goes back to 11 years ago, right? The highest annual pace of 8.6% from 11 years ago. So it's still real.
Yes, and when you look at even just inflation really since of March this year, I mean, it's just been skyrocketing. I would say the only good takeaway is that it's year over year, it's the same as September. It's this 8.6%. So at least we haven't even gotten worse from compared to how we were September, and month over month, we're just a little higher. So it's high, and I'm sure if everybody hasn't already felt it, this reconfirms that prices are much higher across the board, pretty much no matter where you look. I would say the only good takeaway from this report is at least it's not spiking any further than September. And it came a little below expectations. We were actually expecting 8.7 and it came in at 8.6. So very small, tiny positive news hidden within that report. But overall, there's a lot of inflation out there across the board.
Right. Ryan, your thoughts here, because really the spikes came from areas such as gasoline. That was one area. Also autos and auto parts. That was where a lot of the increase came. In fact, beef and veal prices were on the other side, a collective decline of 10.3%. Light motor trucks pulled back a little bit too. So those were some good elements. Ryan, your thoughts?
Yeah, with Erin, I mean, obviously they've come in high. We expected the inflation numbers to be high, and tomorrow we have the consumer price index come out. That's going to remain high as well. But I think, one thing that's important to remember here is some of this is actually transitory. I know it's been every Wall Street strategist's favorite thing to do right now is to make fun of the Fed for being so wrong about inflation with their transitory kind of thesis. But you're starting to hear CEOs say that their supply chains are normalizing a little bit, which indicates that I think some of this, these price increases will start to fade. And I do think that is a positive because it's not like we're going to reopen the economy twice, right? This is a huge phenomenon with the pandemic, with all this cash that the governments around the world have created, and this demand right now is just like, came back like a rocket ship. So some of that will normalize. I think the bigger issue here, though, is what happens with wages, not necessarily the supply chain, which should normalize a bit. And we're starting to see the employment numbers last week were phenomenal, right? We had so many more people back to work, and we're seeing wages go higher, but that labor participation is very low, which says to me, this is going to be the bigger problem that's going to keep inflation higher going into next year.
Right. Ryan, are you thinking about tomorrow's CPI number? How much does it matter to you?
I think it's kind of baked in. Just like Erin just said, we kind of expected PPI to be high. We expect CPI to be high. So I think a lot of that's priced in. What surprises me here, and Erin, I'd like to hear your take on this, is the 10-year is still sitting, under 1.5%. So what's going to be the catalyst to move interest rates higher?
Yeah, that's a really interesting topic. Let's talk about that. But I wanted to talk about small caps, Erin. But give me your thought on the fact that the 10-year is still below this 1.5% level.
Yeah, it's, breaking below these highs that we saw in October, and in fact, even the longer duration bonds are really starting to drop. So I think what it's ultimately saying is the bond market saw this coming. I think that they're interpreting it as, there is going to be higher inflation for quite some period, but it's not going to be these levels, and so that's what we're seeing. Some of the shorter duration bonds come down, and that yield curve even flattening. So it's going to be sort of a stable inflation, but definitely not where we are now.
Quick thought on investing, Erin. I know small caps are on your radar.
Yes. So, for the past 2 weeks, we've just seen these record breakouts in equities, definitely clearly a risk on trade. We saw a bit of a break this morning, which I was actually relieved to see because we had 11 straight days of being up in the S&P 500, breakouts in the small caps. And so now today, of course, they're coming down, they're pausing, which I feel is actually healthy. So I think they just needed some excuse, some report to try to come out. But again, if the problem with the small caps, I was predicting that they would remain in that trading range as long as we saw high inflation. That's clearly not the case. They've decided to break ahead. Investors have decided to be much more positive and earlier than I expected. And it really does look like they are going to be some of the outperformers. So I believe that the Fed repeating that inflation is transitory perhaps has gotten through to investors, and that they're really believing it, and they're starting to take on more of those riskier trades.
Ryan, your strategy here for investing at this point, as we are seeing some folks take on risky trades. I mean, the markets, some of which closed at records yesterday.
Yeah, I mean, bull markets are more fun than bear markets, especially if everything's going up. And I think you are seeing a lot of these speculative bubbles just being fueled right now, whether it's Bitcoin, NFTs. I mean, growth stocks, the valuations are getting very stretched there. I think it's very analogous of the late 90s. And it feels like late 90s stock market fever with, I mean, you had NVIDIA go up like 60% in 4 weeks. Like, that's insane. But, going with what Erin just said, I do think the longer term trade here of cyclicals, and we know small caps are very, very sensitive to what the economy does, is telling you that the economy is booming, it's going to continue to boom. And I think that's why you saw that big breakout in small caps up 6% a month, like insanity. So, I do think it says the economy's getting better. I think as a longer term play, you want to own those cyclicals. The valuations are way more attractive. And when the music does stop, it will. Some of those bubbles that are being formed, it's going to be very painful, no pun intended, again, my last name's Payne, just like we saw in the tech bubble burst back in 99, 2000.
Never painful to have you on the show. We love having you on, Ryan Payne. Always great. Erin Gibbs as well. Ryan Payne, Payne Capital Management. Erin Gibbs, Main Street Asset Management. Great conversation. Thank you both very, very much. Nice to see you.